the top 5 indicators that you should use in your trading. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. The indicators shared in this video are in no particular order. This means that all the indicators shared are equally important. The only thing to keep in mind is that each and every indicator will give you a different perspective of the price action. So, the first indicator is the moving average. Now, a moving average is a technical indicator that calculates the average price of a stock over a particular period of time. This means that a 10-period moving average will show the average close price over the last 10 candles. If you have seen my previous videos, you know how much I love the moving average. Moving averages are mainly used to identify the trend of the market. If the price is trading above the moving average and the moving average is sloped upwards, we can say that the price is in an uptrend. On the other hand, if the price is below the moving average and the moving average is sloped downwards, the market is said to be in a downtrend. Finally, if the price is moving around the moving average and the moving average is flat, we can conclude that the market is in a sideways range. A moving average often acts as a dynamic area of support and resistance. For instance, in an uptrend, when the price makes pullbacks, it will often find support at the moving average and bounce upwards. Similarly, in a downtrend, we can often see that the price pulls back to the moving average and finds resistance. Therefore, moving average can help us in catching pullbacks in a trending market. Different moving averages are used to identify different trends of the market. For instance, a 200-period moving average is used to identify the long-term trend of the market. A 50-period moving average can be used to identify the medium-term trend of the market. And lastly, a 20-period moving average can be used to identify the short-term trend of the market. We can use 2 or more moving averages to get a broader idea of the market structure and market trend. Now, let us come to our second indicator, that is the RSI indicator. The RSI stands for Relative Strength Index. The RSI is a momentum indicator that measures the speed at which the price is moving. The RSI indicator is an oscillator. This means that the value of the RSI revolves from 0 to 100. According to many trading books, when the value of RSI is above 70, it is said to be in an overbought area. This means that the price of the asset has become expensive. Hence, we can expect the prices to fall. On the other hand, if the value of the RSI goes below 30, it is said to be in an oversold R. In other words, the price of the asset has become cheaper. So, buyers will be attracted and they will push the price upwards. The prices do not reverse every time the RSI become overbought or oversold. In fact, in an uptrend, the RSI can remain overbought for a long time. Similarly, in a downtrend, the RSI can remain oversold for longer periods of time. We can also use the RSI as a trend filter. This means that when the RSI is above 50, we can say that the market is in an uptrend. And when the market is below 50, we can say that the market is in a downtrend. Now, the third indicator is a very special indicator for those who are interested in day trading. That is the VWAP indicator. VWAP stands for Volume Weighted Average Price. The VWAP gives us the average price at which the stock has traded throughout the day, based on volume and the price. In simple terms, the VWAP can be calculated by multiplying the volume of the shares traded with the price of the asset. Then divide the total by the total volume. Hence, the VWAP shows us the fair value of the stock for that particular day. A lot of institutional traders and big hedge funds use the VWAP indicator. When they want to buy a large amount of shares of a particular company, they cannot randomly buy at any price. If they do so, they might push the prices extremely high to get their orders executed. Their objective is to buy the shares at a fair value. And hence, they will buy the shares when the price goes below the VWAP. Hence, in an uptrend, we can buy the stock when the price pulls back near the VWAP. Similarly, in a downtrend, we can sell when the price pulls back near the VWAP. Some traders also use VWAP with a 2-period standard deviation lines. This is how they look. The central line is the VWAP line. The upper line is called as the upper band, and the lower line is called as the lower band. We can think of these bands as support and resistance areas. This means that the upper band will provide the resistance to the price, while the lower band will provide support to the price. This brings us to the fourth indicator, that is the Bollinger Bands. Bollinger Bands are two lines that are plotted at a standard deviation above and below a simple moving average. This means that the Bollinger Bands consist of 3 lines. The middle line is nothing but a simple 20-period moving average. The upper line is calculated by adding 2 standard deviation to the moving average, that is the middle line. The lower line is calculated by subtracting 2 standard deviations from the moving average. The main use of Bollinger Bands is to identify if the price is higher or lower on a relative basis. The main advantage of using Bollinger Bands over other envelope indicators is that Bollinger Bands clearly show the volatility of the market. This means that when the market is going through a period of low volatility, the bands become much narrower. This indicates that a strong trending move might follow. Hence, whenever we see narrow Bollinger Bands, we should keep an eye for a breakout to occur in any direction. On the other hand, when the Bollinger Bands become overextended, it can be an indication that the trend has exhausted and is about to end. Hence, it provides an opportunity to book profits. Another thing to note about Bollinger Bands is that the price often keeps on oscillating between the upper band and the lower band. This means that if the price recently hit the lower band, we can expect it to move towards the upper band and touch it. Hence, Bollinger Bands can help us in trading the swings of the market. When the market is in a strong uptrend, the price tends to hug the upper band for longer periods of time. Similarly, in a strong downtrend, the price will stay around and hug the lower band for extended periods of time. Bollinger Bands can be used to identify periods of low volatility and periods of high volatility. They can also be used to trade the swings of the market. This brings us to our last indicator, that is the ATR indicator. ATR stands for Average True Range. As the name suggests, the ATR indicator shows the market volatility of the asset over a particular period of time. In other words, the ATR calculates the distance covered by the price over a particular period of time. When the market is in a strong trend, the ATR will keep on rising and show high value. It doesn't matter if the price is trending up or down. If the price is trending, the ATR will go up. Even in a strong downtrend, the ATR will go up. Hence, we can say that the ATR is a trend-neutral indicator. When the market is in a sideways and choppy area, the ATR will fall and decrease. Hence, whenever we enter a trade, we want to make sure that the ATR values are going up. That way, we can say that the momentum is rising. And a rising momentum can help us in achieving profits. Another way of using the ATR indicator is to identify stop loss and profit targets. For instance, let's say that I want to buy here on this green candle. For some reason I think that this small down move was a pullback, and this green candle gives me a signal that the price may be about to resume the uptrend. So I decide to buy here. Now, to set a stop loss, we will look at the value of the ATR. The value of the ATR at the time of our entry was 82 pips. Now, generally speaking, I like to keep a stop loss that is at least 2 times the value of the ATR. So in this case, the value of ATR will be 164 pips. So we keep a 164 pip wide stop loss, and we keep a target at 1:2 risk to reward ratio. And as you can see, the wide stop loss saved us from making a loss. This brings us to the end of this video. The indicators shared in this video are not to be used alone in trading. Instead, we need to combine them with each other and use price action to create a complete trading system. If you liked this video, then be sure to subscribe to our channel as we share new and effective strategies every week to help you become a better trader. See you soon.